Good afternoon. It is August 23rd, and wanted to go over something that I think is very important right now in the economy and as far as your investing portfolio. By the way, welcome to Simplexity blog. Protecting your assets in a bear market. Technically speaking, by most people's definition, we either haven't hit a bear market yet or we're just coming into a bear market. Bear market technically is a 20% drop from the high of the market to where you're at. So 20% drop from, I believe it's May of 2010 is around 1100 and on the S&P. But what I wanted to talk to you more importantly is how can you as an individual investor protect your assets during downturns in the market, because you can. Most people, financial advisors, have spoken long and talked frequently about buy and hold investing, and that can be beneficial. And if you are one of those kind of investors specifically, then this is very important to you, because those financial advisors don't have the capability, that they don't have the tools or the techniques to be able to truly protect you during a market decline. And what I always think about is, if you have X number of assets, say you have $286,000 in assets right now, and we have a 20% decrease in your asset value, and then it eventually, because buy and hold, it'll eventually go up, right? And markets do, they fluctuate and they go up. But what you're doing is you're losing however much time it took to make that up. So what I would rather help people do is identify macro market trends or swings in the market, not like day trading or anything like that, but times where you have a larger movement up and down, and these are your bear markets. They may last a couple of months, or they may last theoretically a couple of years. Not usually, though. Normally you're talking about cycles of between a month and 9 months to a year. But this is a way that you can actually protect those assets, and it's very simple. It's a complex equation that is really actually pretty simple. So if you can bear with me on a few things, we're going to be talking about two different ways to do this. One in the futures contracts, the other in the options market. The options markets we'll cover next, but for right now, the futures contracts. What there is, if you have mutual funds, those mutual funds, no matter how fantastic they are, they still correlate very remarkably to the S&P 500 index, or if you will. So I'm not disparaging your seeking professional advice, and that these people are just following the S&P 500, but what I'm saying is that if you have a portfolio of $286,000, it's going to have some very similar movement up and down to the S&P 500. Therefore, in the futures contracts, they have designed S&P futures. You see that sometimes they talk about on Bloomberg or on CNBC. There's an E-mini S&P and a regular size S&P. The regular S&P is $250. The value is $250 per point of the S&P. So if the S&P is at 1145 like it was today, that is $250 times 1145, which actually equals your $286,250. Now for the E-mini contracts, it's $50 instead of $250. Mini. So that would be equivalent to $57,250. So here, if you are somebody that has $250,000 in assets, in equity assets, then you could buy and sell one S&P contract depending on the liquidity, and potentially be able to hedge or protect your market loss. Same thing if you had, let's say you had around 50,000 in assets, well, you can do the same thing with just the mini. If you have 100,000, use 2 mini contracts. If you have $1 million used for S&P 500 contracts. And we can talk more about the details of that, but what I want to show you first is how what I think is the most underutilized tool that exists, and that is risk mitigation. People need to get serious about mitigating risk, and this is one way. So here's an example, just a little T diagram. If your portfolio has $286,250, that's the equivalent of one, just straight equivalent of one S&P 500 contract at today's price of $11.45. If the market were to go, so let's say you sell your hedge protection, you actually sell one of the S&P 500 equivalent to your your portfolio value. If the market goes down to 1100, then your portfolio would go down, right? Makes sense. That's what we know. Everything goes down when the market goes down. Not so fast, but that's the case. Most buy and hold long only investors have only the option of their portfolio goes, so the S&P goes down to 1100. That means their portfolio has lost 11,250. They now have $275,000. Okay. Now, the nice thing is though, you'd sold this S&P contract. Therefore, when this goes down, that futures contract is actually making money. And the equivalent money at this point, because we're leveraged equally, or the ratio is equal. So here, this position has grown or increased $11,250. Hooray! So we have basically a break even, right? Now, there was a little bit of cost involved with this. Now, the only cost truly is the round turn that is charged, and that's something that's between you and your advisor, your futures and commodities guy. But that is basically what is the cost is. Now you need to fund an account, but essentially whatever that trade cost is what your cost is, and that could be average, let's say, is $50. $50 for that protection is pretty phenomenal. Now you may say, okay, well, what if it goes up? Well, if it goes up, it's really still the exact same. Now, you only go into this position when you're thinking that the markets are going down, or when you want to risk or hedge against your risk of markets going down. But if it does go up, and let's say, just using our example, if it went up 45 points, then you're up to basically 1190 on the S&P, then everything would just be switched. Your futures contract would be at a loss, but your portfolio would have gone positive because when it goes up, it's positive. So anyway, that is what happens in this position. This is not we're not talking about day trading right now or anything like that, but this is just overall protecting your assets, risk mitigation against potential downturns. Now, and I think it's wise, if there's an outlook or a negative sentiment, for you to take a position that is going to be protected at the very least. Thank you, and we'll talk about options in just a minute.